Our last week together. Time flies. Do you have anybody that's graduating? Congratulations. No slacking in your last week and your last set of tests. It's easy to do. You'll be done with school shortly. Okay, final exam next Tuesday, right? 8:30, Simon Hall 103. I just finished the exam. It's 10 multiple choice, 7 short answer. So short and sweet. I don't think it'll take you more than an hour and a half. It'll be just obviously on the materials we've covered, focus on what we covered in class. If you had any of my other courses, it's similar, same type of stuff. Let me know if you have any questions as you're studying. You get one sheet of paper, front and back. Please handwrite your notes. If something happens between your brain and your hand when you write stuff down. If you don't understand what you just wrote down, spend a little more time on it. Try to understand it. It's not a write down everything from every slide and try to regurgitate it on the test. That's kind of what I'm doing well. Any other questions on? Okay.
It doesn't cover anything from
Nope. But that'll probably help. Yeah. That'll help. But no, nothing directly on point. Okay. Beta Alpha Psi has a presentation on Wednesday. This person is from American Express, Amex. She is a graduate, BSBA at WashU and a MAC from WashU. She's in their M&A controllership practice there. So controllers, in my mind, are kind of the very important people to control the financial statements, control the books. And so she's obviously involved in the acquisition strategies of Amex. I think it's really good to hear different people from different perspectives. If you were in my tax and business strategies course, I try to bring out a little bit about the different stakeholders in an M&A transaction because usually all parts of the organization are mobilized. I came at it from the tax perspective and from an external advisor perspective. She's going to be coming at it from an internal perspective. And each company is a little bit different. How much do they do in-house versus how much do they outsource to advisors? But I'm sure she's going to be talking about how they interact with advisors and how they maximize that use of that. But she's also talking about how accounting and finance weighs in on that. So there'll be all kinds of other things that are in there: HR, treasury, tax. It'd be a great question if you do go to that. How do you deal with your tax people on these transactions, and when do they get involved, and how instrumental are they in guiding the implementation of the transaction? I would argue they're probably central to that role. I hope we do not have technology issues. Okay, so it might be well worth your time on Wednesday. Okay, we're going to pick up with tax treaties and finish off there, and then start in on Pillars 2 and Pillar 1, which there's nothing in the textbook about that yet, because that's kind of cutting edge stuff that's going on right now for multinationals, and we'll carry over a little bit of that onto Wednesday. So I put this in here. Remember we finished with limitation on benefits last time. That's anti-treaty shopping, which is the inappropriate access to tax treaties by a third party who would not normally be able to be entitled to treaty benefits. And remember, the U.S. model treaty had a number of objective measures to determine whether someone was or was not inappropriately accessing the treaty. And so if you have dealing with a treaty with the U.S., you have to do two things. You have to cover off, one, is the other party a resident of the purported treaty country, right? That's Article 4. That's the gate to get you into the treaty. And then 2, you got to deal with Article 22, the limitation on benefits, which adds some additional hurdles to make sure that you're still entitled to treaties even though you may be a resident, which ties into this case. So this case is known as Tiger Global. It just came out in January, which is fairly recent for treaty news to come out. It's January 15th of this year, and this did not involve the United States directly. Okay, so at issue here, the transaction was a Mauritius holding company Remember, a holding company is really a company devoid of activities, doesn't have operations, doesn't have manufacturing or selling going on. Its main role is to hold stock in a subsidiary that is doing the operations. And so this transaction was, we had a U.S. investor who held stock in a Mauritius holding company who held stock in an Indian operating company. The transaction at issue was the Mauritius holding company sold the stock of the Indian operating company to a third-party buyer. And there's a lot of public information about this case. This was Walmart was the buyer. So this was a large retailer in India that was sold to Walmart. Okay? The question that went to the Supreme Court of India was whether this structure should be respected or should they disallow the application of the Indian and Mauritius Treaty, which was at issue here. Mauritius, those of you that don't know, is a very small country and relative to the size of India. And so the bargaining position between the two are vastly different from a negotiation standpoint, because there's a long-standing history between the two countries. And so the issue was whether we're going to apply the Mauritius Treaty or not. The dispute was whether or not Mauritius, being entitled to the treaty, could apply the rule that gave them a capital gains tax exemption from India. So India, unlike many other countries in the world, tax shareholders on their capital gains. So India, absent the Mauritius Treaty, would have taxed the gain at the Mauritius holding company in India. Okay? Unlike the U.S. rule where we apply the seller's residence rule, we do not try to tax non-resident shareholders on their capital gains. So that was what was at issue, was whether or not that capital gains tax exemption applied or not. The Mauritius holding company held a valid tax residency certificate for Mauritius. So Mauritius has been historically a very popular investment vehicle into India because of that tax residency certificate. The tax residency certificate got you in the door of the Indian-Mauritius Treaty, and it was very important from an exit standpoint because, again, India tries to tax these capital gains upon exit of non-resident shareholders. So if you went in, the ownership of India through Mauritius, arguably, you could obtain the tax residency certificate and avail of this tax exemption. So the tax residency certificate is not hard to get necessarily, but you get that from the Mauritius government. Okay? It's not something that India is involved with. So the taxpayer held that it was a Mauritius resident and entitled to apply the Indian-Mauritius tax treaty exempting that capital gain from Indian taxation. The Supreme Court of India denied the treaty benefits. They applied a GAR. GAR is very common around the world. It's called a general anti-avoidance rule. So when you encounter a GAR in other countries' rules, it's basically an overarching rule that says we can disavow any of the tax results that you think you are entitled to if we think there's an inappropriate purpose for what you did. Okay, so kind of think of it as just a blanket exemption where the government can pull the tax benefits away from somebody. In the United States, we do not have a GAR. We have a business purpose doctrine, those types of things. So we have similar tools that the government can avail of to try to withhold benefits from an inappropriate transaction. Most of the rest of the world have adopted these GAR-type provisions that allow the government to have these types of results. So India's domestic general anti-avoidance rule overrides treaty benefits if an arrangement is deemed impermissible tax avoidance. The problem you have with these rules is they are inherently subjective, right? What one person says is impermissible tax avoidance, another person might say is just good tax planning, smart, educated, creative, right? The government auditor might think, no, inappropriate tax avoidance should not be allowed, type things, right? And reasonable, even professionals can differ on that. So the difficulty advising in this environment, planning in this environment is where is that line? Since it's subjective, it's not really easy to find. recall the limitation on benefits provisions we talked about last week, very objective, right? Very objective ways to think about it. And that's what the US was trying to propose, is like, we can't have these subjective standards that nobody knows how they apply. We need more objective criteria. But in the global tax arena, different countries have different rules. Okay, so India has a very subjective rule. So the court effectively held that the Mauritius Holding Company lacked independent commercial substance. The Mauritius Holding Company had a Mauritius-based board of directors. So many times to get these type of tax residency certificates, you have to do a minimum level of activity. One of them is to have physical board meetings in country that you're trying to obtain the residency certificate, and usually have people that are resident in that country on that board of directors. So it's not like you can have US people fly into Mauritius, have a board meeting, and fly back home. That's typically not going to do it. You need some, lots of times you'll see at least half of the board has to be comprised of local residents. So what I have seen happen in many of these instances is you have retired partners from accounting firms, retired partners from law firms who may market themselves as being available to sit on these boards of directors and provide that local presence for your board. But what you find when you deal with local countries is they're very skeptical. Is that a meaningful board? Do they do anything apart from what the investor ultimately tells them to do? So this Mauritius holding company had 2 employees and shared office space, meaning it didn't even have its own office. Okay, shared office space like WeWork, if that's still a thing anymore. Some kind of community office space where you just rent office space for a set period of time. So you see these types of factual things get in the way of an auditor saying, is this a real business? Like, do you make real decisions? You have a real functioning employee base? Do you have real physical premises for that particular company? So the tax residency certificate for Mauritius was deemed merely an eligibility requirement and not conclusive proof that the Mauritius holding company was a genuine Mauritius resident entitled to application of the tax treaty. So think about what happened here. India was presented with the tax residency certificate, so they got in that front door of the treaty. Hey, I'm a resident, I should be entitled to apply this treaty. They nonetheless went in and looked at the actual facts and said, oh, you got the bare minimum, but that's not enough for you to overcome our domestic law, which is a general anti-avoidance rule, and that was inappropriate for what you did to try to avail yourself of this treaty. So, in effect, what India did is says, I'm going to tax the capital gain on this disposition. And this was the Supreme Court of India. The reason this was pretty earth-shattering is because there's lots of U.S. investment into India through Mauritius. And many of those companies that had that investment structure felt like having the tax residency certificate issued by Mauritius was enough. That should be it. They should be able to apply the treaty. So now they're kind of scrambling, saying, what do I do now if my ultimate end game was an exit of this investment and I didn't think I was going to incur Indian tax on that disposition? So it's kind of thrown the investment community kind of up in arms a little bit. So just keep in mind, you might have to just really think about if one of the goals is to access a treaty, do I have a good case as to I need to apply the treaty? And making sure you think through the limitation on benefits, if it's got the objective criteria in there, which ones do I meet? And if I don't, then am I going to be able to overcome a local country anti-avoidance rule like was in Okay, shifting gears to our last couple of articles in the treaty. Article 25 is a mutual agreement procedure. One of the advantages of tax treaties is dispute resolution, right? Global businesses doing business in multiple locations really they go in eyes wide open. They know there's potential for disputes. One country might want to make a change to a transaction, but that might have correlative effects to the other country. And a tax treaty kind of provides a mechanism for where the countries agree to mitigate that potential for double taxation. So a mutual agreement procedure is very important for countries, or for companies. That you can request assistance from what is called a competent authority. I always thought it was a weird phrasing in treaties, but CAs, competent authorities, is the person that is the top administrative official in the country with responsibility for the treaty, for the enforcement of the treaty. So there's the United States Competent Authority. I don't know who it is. Probably Google it right now. But each country kind of puts forth their competent authority. And that's so that you don't get lost in the administration, right? There's bureaucracies at school you've probably encountered. Think of the governments that are involved in trying to get two governments to agree on the application of on the mitigation of a dispute. The competent authorities are supposed to cut through that, get to a person who then champions it for resolution, right? Kind of being the business advocate. They still have to protect their country's rights to it, but let's get to a resolution. This can't go on forever. Okay. So topics where a taxpayer may wish to invoke the mutual agreement procedure could include transfer pricing adjustments. So if you remember transfer pricing we talked about, if you have a transaction that crosses a border, if one country makes an adjustment to the transfer price, I got to get the other country to agree to that, right? Because if you increase or decrease the price, that has an implication on the other side of the transaction. So many times a transfer pricing dispute is a subject of competent authority. These are not quick resolutions, but they give you some framework for resolution. I had a client that had a dispute with Korea. So they had a withholding tax coming out of Korea to the United States. And the Korean government took issue with the amount of the royalty that was paid, wanting to decrease the amount of the royalty that was paid, and because it was a deduction in Korea. And so they went to competent authority under the Korean-U.S. treaty to solve that problem. It went on for years. Now, part of that was Korea has a reputation of being a very difficult country to negotiate with. They get dug in their position and they don't like to give up much. And so it just took a long time for them to finally get resolution to this. So none of this stuff is fast, but the idea is it's faster than it otherwise would be. Determination of the country of residence. So remember we talked about you could be a resident of multiple countries. If you're trying to apply the treaty and it's uncertain whether you're a resident, you can invoke the competent authority procedures to try to understand exactly if you are or not a resident. The characterization of an item of income, right? Is it an interest payment? What type of royalty is it? Remember when we talked about withholding taxes, it goes by type of royalty. Well, is it know-how? Is it scientific? Is it technical? Those types of things you might need to have resolution on that. The application of a source of income rule and the meaning of a particular term in the treaty. So anything within the treaty that might give rise to a dispute, you might be able to invoke the Article 25 procedures. Resolution of the cases made by the competent authorities of the countries. So when they agree, they sign an agreement, it doesn't have to go to court or anything. That's the mechanism within the treaties for dispute resolution, and that solves the problem for the taxpayer. So 1323, I don't believe anybody, I have two more examples. Anybody want 1323? One down.
So in this example, we have USA Code that's a subsidiary of Euroco.
Okay, inbound investment from Europe into the U.S.
USA Code buys widgets from Euroco for $200 and resells them in the United States for $210. The IRS determines that the arm's length price for the intercompany widget sales is only $180 and accesses the additional tax on USA Code. Consequently, despite Euroco recognizing $200 gross income with respect to each widget sale, USA Co. can claim a cost of goods sold deduction of only $180. To obtain relief on this $20 of no taxation, USA Co. and Euroco can petition their respective competent authority to through a mutual agreement procedure.
So Europe sold inbound into the US at 200 and US unsold it for 210. So they had a profit of $10 on the sale. The US adjusted down the intercompany price down to 180, increasing the profit in the United States to 30. So what happens is if Euroco jurisdiction does not agree to adjust the sale price down, you're getting double taxed on $20 of income, right? Because Europe is still taxing a $200 sale to the USA. You need them to drop it to 180. So that's when, if you get an adjustment by the US, you would push forth your position, but if you ultimately agree, yes, you're right, and I'm going to adjust that sales price down, that doesn't automatically mean the European jurisdiction is also going to adjust it. Okay, so you might try to amend the return, the tax return in Europe, claiming a lower sales price from Europe to USA go down to 180. If they challenge that as being an inappropriate adjustment on the part of the taxpayer, that's when you raise your hand and say, I need to invoke the competent authority procedures of the two treaty countries. You guys solve this. I can't be taxed twice on the $20. Okay? And then that's where the competent authorities would have discussions back and forth. Depending on the relationship of the two countries, probably the personal relationship of the competent authorities, in reality, it's going to depend on how long that negotiation takes. That's the mechanism by which you can do this. Okay? If you're dealing with non-treaty countries, much more difficult, right? There is no competent authority process. Your whole process would be trying to convince Europe that your filed tax return with a $200 sales price needs to be amended down to 180. And you may or may not be successful in doing that. But that's the benefit, one of the benefits of the tax treaty. Okay. Article 26 is an exchange of information. Think of this as transparency, sunshine, right? You see sunshine laws in the United States that we should let things see the light of day, right? Because that's more, people think everybody's going to see everything, then that's going to tamp down inappropriate planning and inappropriate transactions. So the tax treaties provide for the exchange of information regarding taxpayers between treaty countries as a mechanism for enhancing tax compliance in their respective countries with respect to international transactions. Okay? It used to be that, you know, we do in the United States, we have a self-reporting system, right? The government waits for the tax reporting from the taxpayers and then decides what to audit. But there was very few instances where the other side of the transaction saw what you were doing on your side of the transaction. So think of two countries. Whatever you were doing on your side of the transaction wasn't necessarily visible to the other country. Exchange of information changes all that, right? So the world has evolved to where you should assume whatever you're doing, whatever transaction you're advising on or proposing is going to be seen by everybody. And when I mean by everybody, not just the countries in which you're doing, but the public, right? Because in today's world, there are whistleblower provisions where if someone within the company or someone within the advising of the company thinks something inappropriate is happening, they can put forth a whistleblower claim, which means that they're reporting to the governments involved that, hey, this inappropriate activity is happening. Many whistleblower provisions, especially in the United States, allow for the reporting party to recover a portion of the recovery by the government. So, and there's tax press. The press is much more interested in tax positions of multinationals and the amount of tax liability that is being paid around the world. So this is just all part of that current of activity of just transparency and sunshine. So under the U.S. Model Treaty, the competent authorities, again, those designated people representing each country, agree to exchange any necessary information to enforce both the provisions of the tax treaty and the internal laws of another country. For example, treaty countries might share information regarding a taxpayer that both countries are auditing. Right? So if one country starts auditing a transaction and they think they need information on the other side of the transaction, If it's a treaty party, they can ask for information about that taxpayer. That's pretty earth-shattering. Most U.S. taxpayers do not want their information shared with other countries. But as part of the treaty process, the United States has agreed to do that. Another example is exchange of list of residents of one country deriving dividends, interest, and royalty income from sources within the other treaty country. The United States really wants to understand where do their U.S. taxpayers have their passive investments held around the world. You guys have all heard of Swiss bank accounts, right? The United States always wants to know who is receiving interest from that country, right? Because they want to make sure that it's being taxed appropriately in the United States. So these provisions can allow for that access to that exchange of information. Okay, our last example. Drum roll. And if you guys have signed up or volunteered over the last couple of weeks, I saw there's a lot of blank spaces. I don't know, I didn't write them down, so you guys need to go into the spreadsheet and make sure you put your name down if you volunteered for. Okay, thank you.
The distributor of candy USACO is a subsidiary of Asia. USACO buys the candy from Asia for resale in the United States. The IRS's international examiner conducts a transfer pricing audit at USACO. After USACO fails to respond to the international IDR requesting all agreements between USACO and ACO, the international examiner requests the information from Asian country tax authority pursuant to the engage of information provision in the U.S.
So the IDR, what that stands for is Information Document Request. And so that's when the government is trying to ask for information, right? They have a transaction at issue that they want to understand more about. They're inherently at a disadvantage because, again, it's self-reporting, so the company has all the information. So they can ask, hey, tell me about the risks, responsibilities, and functions about this transaction. What they're saying here is if I don't get it from USACO, I can ask the treaty partner country whether they have similar information on this transaction and receive it from them. So lots of ways for the governments to get information. Okay. In the United States, we need to disclose what is called treaty-based positions. So if you take a return, a position on your tax return, so you're either making a decision as to what's taxable, what's not, how much is taxable, how much is not, in your foreign tax credit, how much tax you pay in the foreign country that you want to claim a credit on. And if that benefits from a tax treaty, that's different than the provision under the Internal Revenue Code, the domestic statutory law, tax law in the United States, you must disclose that position with its U.S. tax return filing. The tax return position conflicts with the Internal Revenue Code and is therefore treaty-based if the U.S. tax liability under the tax treaty differs from the tax liability that the taxpayer would have otherwise reported in the absence of the treaty. So if the treaty lowers your withholding tax from the United States from 30 to something lower than 30, which many treaties do, that has to be disclosed on the tax return. Okay? By requiring disclosure, the IRS receives notice of the taxpayer taking that treaty-based position that the IRS may choose to audit. I like to think of it as you're flagging the issue, right? Instead of the government having to go in and find it in a tax return, which can be challenging. There's a lot of stuff in a tax return. If you file a treaty-based tax return, it's going to be putting a flag on it, and the government can say, oh, I see you paid interest to the UK, and I know what that withholding tax is. I'm okay with that. Or it's not what I would expect. Maybe I want to ask a question about that. And you do that by filing Form 8833, which is titled Treaty-Based Return Positions. Okay, so I hope you have a lot better flavor of tax treaties. It's by article, and there's some structure to them. Okay, and you have to look at each country that you're dealing with, make sure you can avail of that treaty, and then find what you're looking for within the treaty. Read the entire article, because it's just like the tax code. You might see some general rules, and then you start seeing exceptions, and there might be exceptions to exceptions. So make sure you got a full picture. You don't miss any of the exceptions at the end, but everything can kind of be covered in there that you need to cover in the text. Okay, all right. We're going to go to So these are global initiatives, okay, and they're going on right now. They're being rolled out around the country, around the world. We have an interesting time because they started with the first Trump administration. The Trump administration did not start this. This started out of the OECD. We'll talk about in a moment. But the Trump administration was in power in the United States in the first administration. Then we had the Biden administration, who was more receptive to international initiatives than the Trump administration. And now we're back to Trump 2.0, which is now much more skeptical, again, of these international provisions. And we'll probably have another change in administrations again in a few years. Who knows where we're going to be at that point in time. But my point being is the rest of the world does not wait necessarily on the United States to weigh in. Changes are happening, and global businesses are in countries for the longer term. They're impacted by this, irrespective of what the U.S. view of those initiatives are. So, as an introduction, we have the OECD, right? The OECD, that stands for the Organization of Economic Cooperation and Development. It's an international organization that promotes economic growth, prosperity, and sustainable development. It was established way back in 1961, and it's headquartered in Paris. So what the OECD has is they have working groups on different initiatives. And typically, the OECD, historically, the OECD was much more on non-tax matters. Okay? Economic cooperation and development, right? Raise the social good of the world, right? Broad strokes. But these working groups have, over time, become very specialized, and one of them is on tax. And we were, when I was first starting practicing, these initiatives would come out from the OECD. They would issue a white paper of some goal on the tax perspective. We would read it and say, oh, that's really interesting, and then ditch it away in the trash can, because we knew nothing would happen of it. There was not a lot of momentum to actually embed this in local country laws, because the OECD cannot make laws, right? It is not a country. It has no lawmaking authority. All it does is make recommendations. But what happens is, when you set up a working group, the countries send representatives from their government to sit in that working group. They talk and negotiate about what the change should be. Then what happens, those people go back to their home countries. And if they get an audience with the people who do make the rules and the laws in those countries, say, hey, guess what I did? I spent 6 months in Paris working on this particular working group. Guess what we should do? We should do these 3 things. Because the working groups would purport to send out sample or model rules, if you will. Like, here's our goal, and here's how you should do it. Well, if you had people who were working on that panel, on that committee, developing those rules, they're invested in those rules, right? And they want to go back home, likely excited about their involvement, and want to talk to people about, here's what we should do in our country. That has really, really taken on some momentum, especially in non-US countries. So we have the rest of the world who is adopting these provisions that we're going to talk about here, called Pillars 2 and Pillars 1. And the U.S. is not as far along. Okay? And that's difficult because the U.S. is the largest economy in the world, and usually a leader on certain issues, and the rest of the world is changing. So how does the world change if the U.S. doesn't come along with it? It is an ongoing issue here. So we also have a group of 20, the G20. You guys have probably heard that terminology around. That's an international forum that brings together the world's major economies to discuss economic and financial issues. It was established in '99 in response to the financial crisis that happened in the 1990s. Then we have an even smaller group, the G7, which is smaller, more cohesive group of advanced economies. And the G7 has acted as a policy accelerator and design shaper for OECD initiatives. So you can see, even the OECD gets narrowed down to smaller groups because it's really hard for the bigger group to come to consensus and how do we actually do things. So the idea was if we can get it all the way down to the G7, then perhaps the G7 can be leaders in the world and then others would follow. Not necessarily, but maybe they would. Again, all of these are just advisors. They make proposals. They have no rulemaking authority and no enforcement authority. Okay? So it's just representatives, people from countries coming together in ever smaller groups to debate issues and then go back to their home countries. Having wide endorsement of the G20s, what is called Pillars 2 and Pillar 1 are part of the OECD's, one of the subcommittees that they have, an inclusive framework on base erosion and profit shifting project called BEPS. So base erosion and profit shifting. This is tax planning. Okay? Multinational companies trying to lower their global tax burden. Okay? This was a global effort to try to address this planning. And the reason this is important is because we never had this before. When I first started practicing, there was no global communication or coordination. So it was very, very conducive to tax planning because there was no communication amongst countries. Who did communicate amongst countries? A multinational who was in all these countries. They had inherent advantages because they knew the facts. They learned the laws of their countries. They had bright advisors in their countries, and they could exploit differences between the countries without the countries ever knowing what was going on. That tide has turned. Now countries are talking and communicating and sharing information about what is going on and adopting rules that are mitigating the effectiveness of that plan. That's Pillars 2 and Pillar 1. So there are major steps toward global coordinated tax reform addressing long-standing concerns about tax-based erosion, inappropriate profit shifting, and the challenges of taxing the digital economy. Okay. Remember we talked about permanent establishment, bricks and mortar, boots on the ground. Lots of companies don't need those things to become a taxpayer in a country, or to derive significant amounts of income from another country. A digital economy. So part of this BEPS initiative was to address how do we address the changing of the economy from much more of a physical presence to more of a digital presence. Okay? That's part of that goes through Pillars 2 and 1. The initiatives aim to make international tax system fairer and more equitable for all countries, ensuring that large corporations contribute to the public finances of the countries in which they operate. So very aspirational goals as to what they're trying to do. I think now what you see is an implementation. If one country is going to get a higher tax revenue, by definition, it comes from another country, right? My pie, when we started classes, if one stakeholder gets a higher piece of the pie, a larger piece of the pie, by definition, somebody's getting a smaller piece of the pie. So even if you believe in these goals, somebody's got to be willing to take in less tax revenue. Many people argue that somebody is largely the United States. And that's where the administration has issues with things and can be an impediment to rolling out these types of initiatives. And those companies that are affected too are very, very resource enabled, and they have voices, and they talk to the politicians in their particular countries. So they have a lot of influence on these things as well. They're not passive participants in these matters as well. So Pillars 2 and 1 are a two-pronged international tax reform led by the OECD. The reason I go inversely, right, is Pillar 2 has moved ahead in an implementation standpoint to Pillar 1. So when they were espoused, it was Pillars 1 and Pillar 2, but we didn't go sequentially in implementation. I'll explain to you why Pillar 2 has moved faster than Pillar 1, and they just didn't rename them. But Pillar 2 is the major issue right now. Pillar 1 is kind of on deck, like the baseball. So Pillar 2 aims to establish a framework for a global minimum corporate tax to ensure multinational enterprises, called MNEs, pay a minimum level of tax regardless of where they operate. Okay? So the idea is we should have a minimum rate of tax that you incur in every country in which you operate. Not a minimum tax globally. So this is not a global effort. We're not trying to say Microsoft needs to pay a minimum rate of tax. We're trying to say Microsoft needs to pay a minimum rate of tax in every country in which they do business. Or we're trying to be fair and equitable amongst the countries. So it's in every jurisdiction in which they operate. Conversely, Pillar 1 focuses on reallocating taxing rights to market jurisdictions where M&Es generate revenue. So Pillar 1 focuses on where M&Es should be taxed. Okay? This is the digital economy issue. Pillar 1 is about digital businesses, companies that do a vast amount of business without having a permanent establishment in the country. And the idea is we need to take some of that profit and give it to the market jurisdiction, the customer jurisdiction. So think of, I'll just pick on, say, Google doing business in France. I've never worked on Google. I don't know if Google has a Google France subsidiary or not, but let's just assume they do not. But they are accessing the market in France for search and getting a lot of revenue from French advertisers for the Google search platform in France. And let's just assume, for sake of our discussion, that we do not need to have a physical presence in France, nor do we need to have employees in France. So I do not have a historical permanent establishment in France, meaning Google US is not a taxpayer in France. France would be arguing, yes, but you are availing of significant business opportunities in France. You need to help pay for the infrastructure that gives the environment for which those people can pay you. So Pillar 1 is trying to pull some of the profits towards the market jurisdiction, irrespective of the historical permanent establishment threshold. It's going to lower threshold for which you become taxed. Okay? The reason Pillar 1 has fell behind is because that is pulling income largely from the United States. We have the vast share of the large tech companies that can do this type of business, and they're raising their hand and saying, you understand, if this happens around the world, we're going to be paying less U.S. tax. And that's where company perspective is not necessarily concerned where they pay tax, as long as they only pay tax once. What they're saying is, be ready for me to claim a lot of foreign tax credits in the United States. Start making me pay tax in other countries, I will claim credits against the United States, lowering my U.S. tax liability. That's where the devil's in the details. That's why Pillar 1 has fallen behind in the implementation timeline compared to Pillar 2. Okay, we're going to dive into Pillar 2. So, Pillar 2 introduces what is called Global Anti-Base Erosion GLOBE rules, setting a minimum tax rate of 15% that multinational enterprises must pay in each jurisdiction in which they operate. So again, they don't set the rules, but they're just saying this is the proposal. You, as participant countries in the OECD, should implement rules in your country that impose a minimum rate of tax of 15%. It is designed to prevent avoidance by ensuring MNEs provide a minimum rate or incur a minimum rate of tax in otherwise low tax countries. This requires MNEs to pay what's called top-up taxes. So top-up taxes, you probably have heard me say residual tax, incremental tax when we're talking about foreign tax credit. That's what it means. It's just bumping wherever you pay tax, whatever rate is. If it's below 15, we're going to top it up to 15. Okay? That's the aspirational goal. You should pay 15% in every country in which you do business. So remember when we talked a few weeks ago about tax havens? If you were able to put money in a tax haven, earnings in a tax haven, and not run afoul of Subpart F in the United States, you might have a zero rate of tax. Pillar 2 says somebody should collect that up to top it up to 50. Okay? We're gonna go through the 3 mechanisms for collection of that top-up tax of 15%. So the idea is to look around the world. You have pockets of income where you're not paying up to 15%. It's in some ways gonna try to pop it up. Okay? It mitigates the benefits of perceived aggressive tax planning on the part of multinational enterprises and prevents a race to the bottom in terms of enacting corporate tax rates. So if you think that there is tax competition around the world, meaning countries are trying to attract investment and from multinational companies because one, that means jobs, and jobs mean the social standing of the public is better in their countries. So one way they can do that is to attract them with lower tax rates, right? Well, if the world has adopted a 15% tax rate, it doesn't make any sense for you to offer 10% as an incentive because the company will say, I know that's not real because I'm going to get taxed and topped up to 15 somewhere. We're going to go through somewhere shortly. But it prevents that race to the bottom. Because if you have ever increasing competition, then it's just who can get to the lowest rate of tax. And that might attract the most investment. So we put a floor on that. Now, who's behind that? Largely Western European countries that have higher tax rates. Germany, France, right? They're the ones who are saying, we have the customer base, we have the consumer base, and we see inappropriate profit shifting and a chase to lower tax jurisdictions that we think is inappropriate. So arguing for a minimum rate of tax. That means that you still get some benefit, right? If you can go from Germany's high 30s down to 15, that's still meaningful, but it's not as meaningful as high 30s down to 0. Okay, the applicability of Pillar 2. So there's which countries are impacted by this? So it's going after large companies, right? So there's a size threshold. Multinationals with group consolidated revenues of greater than 750 million euros in 2 of the last 4 years. So again, we're not trying to impose these burdens on medium-sized companies. 750 euros of revenue is pretty high, right? So we're going after the ones that are really moving the needle here because we understand that these rules would be very burdensome for smaller and middle-sized companies. You need to be a multinational. Companies with subsidiaries or operations in multiple countries. If you are a U.S. domestic company only, you don't even know what Pillar 1 and Pillar 2 is because you're only doing business in the United States. And guess what? You're going to pay tax at 21%. That's the federal tax rate, and you're going to layer on state taxes for whatever states you do business in. But there's not a lot of effort, not a lot of benefit for trying to do much tax planning cross-border because there's no ability, you're not shifting anything, right? Whereas you start being a multinational, now you can be potential for this lowering of tax burdens. There are exemptions for government entities, select international organizations, and pension funds that are generally excluded. Some industries where the profits are highly regulated may have specific exemptions as well. So we're really looking for commercial enterprises. So we're looking for large, multinational commercial enterprises, right? And that keeps the smaller businesses outside of this problem. Okay. The mechanics, we have an income measurement exercise. The calculations begin with financial statement net income, subject to adjustments. Okay, so we are not going to just look at what tax rate each country has. We want to measure what your effective tax rate is. So that has us start with what is your financial statement income, and then we make certain adjustments to it. We do that in the United States. If you had my business entity scores, remember tax accounting, we started with book income, and then we made adjustments to get to taxable income. Because book income is a good starting point, right? We have financial statements, we have a general ledger, we have revenues, we have expenses, so it's got a good launching point. So here we also want to start with book results and then make adjustments to get to the base for which we determine this. The tax measurement is accrued taxes, so that's current and deferred count here, and income tax are included, subject to complicated adjustments. So this is one reason why they made this only applicable to companies with 750 million euros and above revenues, is because we're adding burdens, right? America saying, oh my gosh, you're just creating a whole new system for us to do this. For you guys, job security, right? Just making things more complicated in the world is not bad. There is a substance-based carve-out. So excess profits of low-tax subsidiaries with substance can be reduced by 10% of the consolidated payroll and 8% of book value of tangible fixed asset. All thresholds decline to 5%. So they are saying, okay, we do understand that you might be in a low-tax jurisdiction, that you're really doing business, substance, real sales, real manufacturing happening. We think that's the rare case, but that might be the case in certain instances, so we want to have a carve-out, something that's going to lower these thresholds. Okay, so that's who we're aiming for. Okay, so in the model is to have a 15% minimum tax, a 15% minimum tax, and if you're below that, we want to top it up to 15. We're going to raise it up to 15. The question is how do we collect that? Okay, and this is where the drafters of Pillar 2, I think, got very creative, because they made each country kind of being checked by other countries in doing this. By the way, so we've got 3 mechanisms we're going to go through that can collect, where countries can collect a top-up tax when those calculations indicate a tax below 15%. So the first one is called a qualified domestic minimum top-up tax. This is one area, when you hear people talk about this, it's crazy. They call this the QDMTT. They'll start using all this alphabet soup, and you're like, what are you guys talking about? But I think if you really hone in on the words, qualified domestic minimum top-up tax. So this allows a jurisdiction to impose a top-up tax on its own constituent entities located in its territory when the effective tax rate is below 50. So we're looking at, this would be like the United States. If they did a QDMTT, they would say our U.S. companies need to pay at least a 15% tax rate. You guys know from business entities, we have a 21% tax rate here. So you're like, well, check the box on that. That's all there. But remember, you have, it's based on financial income. It's a different base compared to federal income tax. Okay? So if that base has a tax rate associated with it that pulls the effective tax rate below 15%, if we had a qualified domestic minimum top-up tax, that would mean we'd bump it back up to 15. Now in the United States, we do have a corporate alternative minimum tax, another regime, which is trying to do the similar thing. Okay? Trying to look at financial statement income and say, why didn't you pay a minimum rate of tax on that and try to increase that? That's the same concept as a qualified domestic minimum top-up tax. So let me give you an example of this. I'm trying to give you examples of these things so you can see how they work in practice. So just get used to some of this terminology here. I got an ultimate parent entity in the language of this provision. So UPE, ultimate parent entity, that's the top company that owns this. And I got subsidiary B and subsidiary C. So country C has adopted this qualified domestic minimum top-up tax. And so you'll see here my facts in country C for subsidiary C is I have earnings of 40 and for some reason I pay tax of 0. Let's just say that's accelerated depreciation or something like that, some type of research credit or something like that that pulls their tax liability down to 0. Okay? So that would be a problem. It's not 15%. Right? So if country C has adopted a QDMTT rule, then country C collects a $6 top-up tax from subsidiary C. Does it mean $40 times 15% is the $6? So that's the country itself bumping the tax collected from country C up to 15% on this base that they determined for this particular. Okay? So think of that as encouraging each constituent country, go out there and enact a minimum tax in every one of your locations, every one of your countries. That's one way we can have a top-up tax, right? The second way is what is called an income inclusion rule, IIR. imposes a top-up tax on the ultimate parent entity for the earnings of its subsidiaries with an effective tax rate of less than 15%. If the UP does not adopt an IRR, any intermediate jurisdiction may apply its own IRR to the UP subsidiaries with an ETR below 15. So what that's saying is the ultimate parent entity we're going to try to incentivize them, have your top-up tax imposed under your country's law. Think about what we talked about in half A. Guilty, net CFC tested income. Those are minimum tax regimes, right? They're 15%. The US was a leader in this area because Trump 1.0 in 2017, they enacted guilty. That was the first jurisdiction in the world that had that type of a regime. The OECD said, oh, that's a great idea. Let's espouse something like that. They just named it something different, income inclusion rule. But it operates a similar way. Ultimate parent entity, look at your subsidiaries. If they don't pay enough tax, then you, parent company jurisdiction, top it off. That's exactly what happens when you claim a credit from a guilty inclusion that's not up to 15%. You top it up. Okay? It's the preference under the OECD model is for this to apply on a country-by-country basis. So what that means is we take all of the subsidiaries in a country and we do this calculation collectively. Okay? Think about our guilty rules and our net CFC tested income rules. We do that on subsidiary by subsidiary. We don't add all the subsidiaries in a country and do the calculation collectively. So that's a difference. This is important because the US has a rule that's kind of similar but not exactly the same as the OECD. This has priority relative to the undertax payment rule we discussed next, but it falls behind the qualified domestic minimum top-up tax that we covered 5 minutes ago. So there's three mechanisms for collection. So think of it as a layered approach. So first we look, did you have your own domestic minimum tax? That gets priority. If you don't have that, then the ultimate parent company can top it off. And let's just finish off the income inclusion rule. So what this looks like is same facts, but I have down here, subsidiary C did not enact a qualified domestic minimum top-up tax. Okay? And I have earnings of 40 and tax of 0 for whatever reason under this mechanism. So country C has not adopted that first collection mechanism, but country A has adopted an IRR, income inclusion rule. So country A collects the $6 top-up tax from UPE relative to the results of subsidiary C. Subsidiary C is $40 times 15% is $6. That minimum tax is higher than the 0 that they actually incurred under country C. And subsidiary B over here is fine because $200 times the 15% is 30 and they paid 40. So they're outside the scope of this, but this low tax income is taxed by country A. So think about what's happening here from the architecture of these rules. If country C sees this and says, oh, the top-up tax is being incurred, but it's going to country A. What we should do is do our qualified domestic minimum tax and turn that on, and then we collect the $6. So we started writing these rules so that they're going to be collected somewhere, and once countries understand that it's going to be collected somewhere, then they say, why not us? And it can be, you just have to change your law. I think the drafters did a great job here of dealing with what was normally a very decentralized rulemaking effort, and everybody doing their own thing is like, okay, well, let's set the rules up to where once people understand how they work, they're going to make sure that their lawmakers understand that and make the rules the way that they can collect them. Okay? So this low tax earnings is taxed in country A under the income exclusion rule, just like it would have been as if this was a U.S. company under GILTI and NCTI. The U.S. would have picked up this income as well. Under our own rules, not under the OECD rules, under those rules. Okay? So go to the third and last collection mechanism, which is called the undertaxed payments rule, UTPR. Again, it's really dense when people are going through this stuff about talking about because they use all the acronyms. But UTPR. So this is the backstop rule. So if you don't have the first rule, domestic minimum tax, you don't have the income inclusion rule, then you could be topped off by the undertaxed payment rule. So this rule denies deductions or requires adjustments to the income of other group subsidiaries should the low tax income of another group subsidiary not be subject to top off under either of those prior two rules. So this is saying, well, if nothing happens in those other two, I'm going to let somebody else in the group collect the top-up tax. And it effectively tops up the regular tax of the low tax foreign entities with an effective tax rate below 15 that are not otherwise topped off in those first two rules. Additional taxes collected by UTPR jurisdictions and allocated among UTPR jurisdictions based on the relative shares of total employees and total assets. So, you'll see in the example here, the tax can be collected by disallowing deductions in the subsidiary to the subsidiary in the UTPR jurisdiction. So that other country can enact a UTPR rule and try to pick up the income of the low tax entities by denying deductions in the UTPR jurisdiction. Right? If I can back into the top up tax by lowering your deductions to pick up that $6 that we were just talking about. Okay. However, there's no requirement that an entity in the UTPR jurisdiction actually makes a payment to the low tax subsidiary. In such case, there is simply an additional cash tax expense imposed on the subsidiary located in the UTPR. So this was kind of earth-shattering when we first saw this. We're like, okay, you don't even have to be associated, touching the low tax jurisdiction by making a payment to them. We can just collect the tax by adjusting your tax liability. So what does that look like? So now I have the same facts here, but I have subsidiary C, country C, did not enact the qualified domestic minimum top-up tax, nor did UPE, country A, enact an IRR. So now we have low taxed earnings. Who gets to get the top-up tax? Subsidiary B, if they have enacted the UTPR, they are entitled to collect this tax over which they may have no connection. Okay? So country B collects the $6 of additional tax from subsidiary B, not subsidiary C. Subsidiary B, and it's a $6 by adjusting the deductions of country B. So again, think about how all these things work. If countries out there will enact the UTPR regime, they can pick up all of the low tax income around the globe by denying deductions to their countries in their location, by having the undertaxed payment rule. What does that do? That gets other countries to say, oh, I have this $6 from this activity that can either be taxed here or here. I need to enact a qualified domestic minimum top-up tax, and UP country says I need to enact an income inclusion rule to pick up that tax. Otherwise, it's going to go to country B in this example. So I think, again, an ingenious way to write the rules to kind of force countries to adopt these rules that otherwise might not. Okay. Here's a great decision tree I found on the internet. So, first, is the multinational entity in scope of Pillar 2 or not? That means, are they multinational? Are they paying tax in more than one country? And is the consolidated revenue threshold met over 2 of the last 4 years greater than 750? If you're not, then skip this. You're done. Right? You're either a small multinational or you're not a multinational. Okay? You answer yes to that. Is the subsidiary subject to an ETR of less than 15%? If you don't have any of those entities, no top-up tax. Right? If it's yes, then you start tumbling down through the tiers of the analysis. So, has the jurisdiction of the low tax subsidiary adopted that qualified domestic minimum top-up tax? If it's yes, then you pay that to that country of that low tax subsidiary. That's the first priority. Second, as the UPE, the parent company adopted an IRR. Yes, then you top up taxes incurred in the UPE jurisdiction. And they collect it. If you no to those two, then we fall to the last one, the backup, which is the UTPR jurisdiction can pick up the income. I think this is just the way to kind of think through this. Okay. So comprehensive example. So bear with me, and this will show you how complicated this is. And what I would just ask you to think about is just think if you had 200, 250 subsidiaries in 50 countries. You're doing this analysis on this. This is where companies are saying, "Oh my God, this is really hard to implement." Right? I got to be able to collect this data. And I got to be able to get it to the base that you want it to be, because you're not looking at your local tax base. I have to recompute all the tax bases. Okay, so let's walk through this. So I got UPE at the top. They have no income inclusion rule. And then I have CFC2 going down the right side. They have done a qualified domestic minimum top-up tax. And that country has a 10% ETR. I should have said up here at the top too. I put in the bottom right corner of each box what the effective tax rate is. So I have a parent company that itself is at 14%. So they're below the 15% as well. And then I have on the bottom right here, I have 3 consecutive subsidiaries who have lower tax ETRs below 15%. On the left side, I have CFC1 who has done both an IRR and a UTPR enactment. And then country 3 on the bottom left has a qualified domestic minimum tax. So let's just go through and see how you put all these pieces together. Okay, so starting off at the, let's start off with my low tax subsidiaries at the bottom. So these 3 entities here at the bottom. All 3 of them are below 15%. They have no qualified domestic minimum top-off regime. So I'm done with the first priority of that decision tree. And now I go to, is there an IRR regime in the ownership chain? I go up to CFC2, no, that's not got an IRR. And I go up to country Z and at the top, and that's no IRR as well. When I go over here to the right, I should have this guy. Country CFC4, his income would be included in CFC1's top-off tax because they have an IRR regime, so they're going to bump up their subsidiaries and collect the top-off tax. And CFC5 and CFC6, low tax, are collected via the third layer of the collection, which is country A is going to collect this via their UTPR because they're not under the ownership. Okay. Country 3 over here, CFC3, sorry, the top-off tax is collected by country C via its qualified domestic minimum top-up tax that they have. Country picks it as well. Look at what's weird that happens at the parent company level. Their top-up tax, because they're only at 14%, that actually gets collected by a lower tier jurisdiction, which is country A via the UTPR, because they get to collect it as well. So if you start stepping back from this and you look at this, it's country A is getting super rich here because they have the UTPR that is picking up the gaps where other countries have not fully enacted Pillar 2. Once the world sees this, the idea is those countries will waken up and say, oh, we need to do QDMTTs or at a minimum IRRs to collect our share of the global pie instead of letting country A get everything. Okay? But the whole goal here is to try to get the rate of tax in each country up to 15% via this top-off mechanism. This is the number one challenge for U.S. multinationals right now, is dealing with this around the world. This reporting is starting right now. So, for U.S. parented groups, the question is, do we have an IRR or not? We don't have it by name, but we do have a GILTI regime that's been around from 2017 to 25, and now we have net CFC tested income to 25 forward. So, Trump 2.0, the administration, came in, and we had Secretary Besant was the major party negotiating with the OECD and the G7, and was arguing our rules are substantially equivalent to your rules. We're going after the same thing. We have a minimum rate of tax. We have a different way of computing it, but we led the world doing this because we enacted this in 2017. You've come along with a different set of rules. We are not going to change our rules. We're the United States, that's part of it. Secondly, because we don't have another tax bill to do this, right? And we have to get the votes to do it. So, are we good enough was the discussion with the G7. So, on June 27th of last year, the G7 released a statement announcing an agreement with respect to the potential application of Pillar 2 to U.S. parented groups. This is called a side-by-side agreement, side-by-side approach. What that means is the two regimes can run parallel, and they're equally effective. Okay? So it excludes U.S. parented groups from UTPR and the IRR with respect to both their foreign and domestic profits. And domestic profits. Very interesting. So, U.S. is 21, so you'd automatically 21%. So you'd automatically think, well, the U.S. should be fine on your domestic profits. But we know we have lots of companies that have an effective tax rate below 21 on their domestic activities. If you remember back to the taxation of business entities, I showed you an example of, I believe it was Microsoft with, no, it was Meta, sorry. Meta, which was Facebook, with stock options. The exercise of large stock options by Zuckerberg and his executive team. You get a large tax deduction under the general tax rules for stock options for non-qualified options. And that was driving down book income to low taxable income. So their measuring of their effective tax rates way below 21%. Okay? But this is saying effectively the U.S. rules are effectively grandfathered because of this side-by-side approach. So basically means that U.S. anti-deferral regimes, the GILTI, or 17 to 25, NCTI 26 forward, are functionally equivalent to the OECD's minimum tax rate. And the U.S. domestic tax system already produces an effective tax rate of at least 15%. That's the corporate alternative minimum tax regime that was directed at the meta situations of the world, taking accelerated depreciation or outsized stock incentive deductions and lowering your taxable income relative to book income. So this G7 agreement has protected a lot of U.S. multinationals, but what it doesn't do is numerous countries have either enacted or are in the process of enacting Pillar 2 rules, including compliance requirements on all of this reporting. So that big org chart I showed you with all the countries doing different things, those countries are doing that. Okay? There is a timing problem faced by corporate America. The side-by-side approach helps, but does not eliminate the near-term accounting problems for U.S. multinational groups. They are facing this right now in Q1. Or in Q1, sorry, we're just outside of Q1. The timing problem exists as Pillar 2 rules are already enforced in many non-U.S. jurisdictions, so they've been enacting qualified domestic minimum top-up taxes, they're doing IRRs and U.S. UTPR rules around the globe, and it differs by country. But the G7 agreement has not been fully implemented under the laws of their countries. Right? A G7 agreement is just an agreement amongst the parties. It's like what they're trying to agree right now in the geopolitical world. It's just an agreement. It hasn't been taken back and put into the laws of the country. Tax accounting goes by enacted laws. So if you're dealing with an enacted law that's in place in a foreign country, the G7 agreement is not enacted law. Right? The countries have to go back and get the votes, pass the law, get it signed, and enforced. Then the accounting rules apply. So what you have is you have U.S. multinational groups that can still incur the top-up tax abroad in the interim until they get this G7 rolled out into their agreements. So until that is fully implemented, U.S. groups need to assess and potentially accrue Pillar 2 top-up taxes under ASC 740. So it wasn't a big sigh of relief that, oh, we got this G7 agreement, I don't have to deal with this. Under the accounting literature, you still have to deal with it, knowing that ultimately I'm going to be okay when we get the G7 agreement into the laws of every country. But that doesn't happen overnight, right? There's elections going on, there's different profiles in different countries. Can you enact it in the laws, those types of things? And you got the US sitting out here saying, we need to get these in place, but how do you get those in place? That's the problem we have right now amongst companies. So the challenges faced by multinational groups is new costs for data collection and compliance, right? All this stuff we talked about, lots of stuff to do, right? How do you collect all this? How do you get this information from the financial system? Administrative headaches in gathering the right data efficiently. Heightened risk of tax controversy. That work structure where I showed you everybody doing different things, you don't think that's going to give rise to controversy? There's going to be all kinds of tax disputes. One country saying, oh, I'm entitled to this. Another country going, no, you're not. And the company, no, you're not. How do we deal with that? And how is there any end in sight on the tax controversy perspective? Information sharing amongst jurisdictions. Right? How much is each country going to be sharing with other countries from an information flow? The ongoing flow of global administrative guidance. So these rules are subject to ongoing releases of guidance, administrative guidance as to how to apply these rules. That stuff just keeps coming out, right? Somebody's got to follow that. Somebody's got to be responsive to that stuff. And then classification of the GILTI and CTI regime as a blended CFC tax regimes requiring specific allocations given that the U.S. does not apply the regimes on a country-by-country basis, aggregating all subsidiaries within a country. So if the G7 agreement hasn't been implemented, then our GILTI and CTI rules are going subsidiary by subsidiary. But these other rules in other parts of the countries are looking at countries in total. So if I have 3 Mexican subsidiaries, they're applying the rules on collection, all 3 of those together, whereas we're applying GILTI and NCTI on a company-by-company basis in my 3-scenario example. So you have to parse that out and separate that out, which can not be as easy as one would think. Okay, so that's Pillar 2. This is going on right now. It's being rolled out around the world. The U.S. is trying to influence it through this G7 agreement, but that G7 agreement hasn't been implemented, so we're in kind of chaos right now. You can imagine what's going on in corporate America is, how much effort do I put into this, knowing that it might ultimately be resolved in the near term? In a year or so, this might all kind of quiet down or 2, but right now it's just still pretty chaotic. Okay, what I'm going to do on Wednesday is we're going to cover Pillar 1, because I think that's on the horizon, and I want you to see what that's doing for the digital companies of the world. And then probably do a course wrap up and maybe a little summary of review. Okay? Great. Thank you.